Maurice had a question earlier this afternoon. And Maurice had attempted or was looking to enter, if I'm not mistaken, a bull put credit spread for next week's expiration. I think it was the 16th, Maurice, but maybe it was for today. That's perfectly fine. And what he intended to do was enter in a bull put credit spread. I don't want to say it was fairly aggressive, but it was selling the 33.90 put and buying the 33.80. There we go. So just select those there in the drop down. We're going to sell the 33.90 and buy the 33.80. Let's scroll down to our actions here below the chain. There we go. Okay. All right. And so what he thought he was doing is selling the 33.90, buying the 33.80, the lower strike further out of the money put. Credit of about 35 cents, it looks like. Up at midpoint, it was even, but I think he was getting a net credit of during the day of about 35 cents or so. Yeah, so 3.6%, maybe it was a little bit higher, but this is the trade, the bull put credit spread that he was looking for. You know, the market's above here at 39.34. High probability of this trade expiring worthless. But what happened is he noticed in his entry that he accidentally sold the 33.80 put and bought the 33.90. The actions were reversed. Now, in this case, what did he end up doing? Well, he ended up entering, he didn't know the name of this type of strategy. He didn't know what this was. As it turns out, of course, he had entered into a Bear Put Debit Spread, but a Bear Put Debit Spread that was deep out of the money, which is not what we want to see at all. Okay, in this strategy in a Bear Put Debit Spread, I'm sorry, it wasn't the 33.80 and the 33.90. It was the 38.90 and the 38.80. That's why that looks so off. Let's clear that up again. Let's show you what he did do correctly, and then we'll come back to the discussion at hand. So again, we'll just go to standard December 16th expiration. Get the proper function going here. 38.80. 38.90. Okay, so I know you're not seeing what I'm doing here. It's just to save the scrolling effect for you. All right. So initially, again, once more with feeling, what he had intended to do was this position, a 31.6% return roughly, but SPX was a little bit higher when he entered the trade today, when he had emailed me. So, but in any case, we're looking at about a 31.6% return, 38.90, about 40 points out of the money for SPX. This is the trade that he wanted. Unfortunately, he had entered into this trade, the Bear Put Debit Spread, which is a 316% return. But in order to reach profit, SPX has to drop to 38.87, about 50 points down. And to reach the maximum profit, we've got to drop below 38.80 to close out the debit spread. Now, what's the difference between the two? On the credit spread, we took an initial net credit on the bull put, 36 cents. It was a little bit higher than that. It was a couple dollars. And if the stock stayed above our strike price that we wanted here, well, both puts would have expired worthless. We would have kept the net credit if we stayed above 38.90. Let's get this drawn correctly. Fantastic. All right. So what he initially wanted, of course, was this transaction, but it had a little bit lower return, so let's do it here, okay? So as long as the stock stays above both strike prices with what he wanted, both options, both puts expire worthless, and he kept the net credit. In a bear put debit spread, you're expecting the market to fall or possibly remain the same, but you're using different strikes. You pay a debit to enter the position, and if the stock is trading below both strikes, let's take it as a stock rather than the index, what do you have? You have a sold put here that's in the money. You're obligated to buy shares of stock at this price, but you own the right to force someone to buy shares of stock at this price. So that means you'd get $10 back. In this case, forcing someone to buy your shares of stock at $38.90 that you're delivering at $38.80. I'm sorry, you're buying at $38.80 and forcing someone to buy at $38.90. So you get $10. Minus that would be the $760 profit or the 316% return. Now, we do have a full playlist on this on YouTube on the Bear Put Debit Spreads, and I'll reference that in a moment. But Maurice's question was, number one, when would you choose to use a bear call over a bear put debit spread? And when would you choose to use a bearish spread position? Well, naturally, the answer is you would choose to use a bear put debit spread or a bear call credit spread if your sentiment is the market is weak and is going to start to decline in value. Or, as we've shown in the past, when you start seeing bearish sell or very bearish sell warnings on the Power Options Market Sentiment tool, that's when we'll usually start to protect our bullish positions, add insurance to them, close bullish spread positions that are at a profit, and then maybe look to convert some of the spread portion of our portfolio or other portion of our portfolio to bearish spread positions. So what we're looking at here is not a structure. Now, Fernando, I see your question. I'll get to that in a moment as an add-on. But what we're seeing here is not the structure I would use for a bear call or a bear put debit spread. Typically, we'd want to be up here, which would be out of the money for the bear call credit spread with that higher probability of expiring worthless, which is what we want, or in the money with the debit spread as a parity trade to give us, again, that higher probability of being below the short put strike price to receive the maximum profit, rather than speculating on a big move down where we'd have this extreme profit on the position. So, what structure would we use? Well, typically with any credit spread, bull put credit, which he was attempting to do initially by selling the $38.90. Now let's take a look at the probability here. Let's go to the research tool and option research real quick. Let's look at the delta and the probability of this $38.90 put, which he originally intended to sell as part of the bear put debit. Now it's only got a probability of 62.5 and a delta of 0.35. For me, that's not good enough even on SPX. I'm typically looking for a probability of 75 or 75% or higher on a credit spread, probably with a delta around 0.20 or less, respectively, not including the negative put delta in this case. That's what I would want to look for, to have the higher probability of expiring worthless, keeping the net credit. And I may look for the same in a shorter term debit spread, because I want that better probability of being assigned. 7 days out, 14 days out, unless I have a really strong sentiment that the market's going to fall. So what we might look for without going to the chain, let's say, I think 40-10 or 40-20 is a good move, good range out of the money, maybe 40-20. Let's see if we can get anything reasonable at the 40-20 strike. For our, I'm sorry, I was thinking about calls again. I want to go a little bit lower than he was. We're going to go to see if there's good value at 3,800. I think that's a good range out of the money. We're going to find out. So, looking to sell the 3,800 put rather than 3,890. Keep a 10-point spread. Buy the 3,790. Now, this isn't going to give me the return I want, but it is SPX, so it has a lower volatility. We haven't pulled up the graph yet. I'm just eyeballing it. So with the bid-ask spread, we sell our higher strike and buy the lower strike. We're out of the money, below the stock price. $1 net credit on a risk of 900. The difference in the strike prices. This is for the bull put. An 11.1% return. Good, reasonable. What is our probability here? Now, I'd be using the search tool naturally to set the probability I want and save time with all this. Yeah, 83.5, perfect. Okay, so maybe I'd go to 80, go to a little bit of a higher strike price, maybe that 38.05, maybe the 38.10. But this is a good probability that I'd look for, the delta I'd look for. The return is not bad considering SPX. Normally in a bull put credit spread, I like a 14, 15, 16% return. Lower volatility with SPX with the probability I want. So I might be okay with that. Now, the parity trade to this bull put credit spread, the parity trade to this bull put credit spread would be the bull call debit. I would use the same strikes. Now, with SPX in the 3800s, we expect to see a $1 or $2 bid-ask spread. Here we're at roughly 90 cents. That's not too bad at all. I'm sorry, $1.10. My apologies there. And about 70 cents here with the out-of-the-money puts. So getting the midpoint price is relatively feasible. However, if we switch this, we go to the same expiration and the same strikes, but with the calls, with an in-the-money debit spread, where we'd be selling the in-the-money 3800 call in SPX, and we don't have to worry about early assignment because it's European cash settled in this case. So we do the 3800 and the 3790 calls. Now remember, the return we were looking at on our bull put credit spread, and I know Maurice wanted to talk about bear puts, we're getting to that in a moment, but the return we were looking at was 11.1 with about an 83.5% probability. The parity trade, same risk reward almost, selling the 3800 call, buying the in-the-money 3790. The bid-ask spreads aren't bad. They're only about $2 or $3. But the prices are such, in this case, that it does not give me a profit. That's very interesting. Usually you'd see that. Did I do that right? I think I did that wrong. No, I'm selling the 3800 call, buying the 3790. Now, while we're here, let's take a look at what Maurice wanted. Let's take a look at the bear put debit spread versus a bear call. I have a sentiment that the market's going to decline, but I still want to have the good probability. I don't want to necessarily take the chance of an at-the-money spread 7 to 9 days out in time. So I want a good probability, let's say on our bear call credit spread, and with SPX around 39, 34, I think we saw that the 3890 wasn't right. So I'm going to drop down. Let's go to 3850. Good. And we'll go with 3840. So this is going to be our bull put credit spread. So we're going to add those two in from the chain. And then we're just going to move down to our entry for our positions. What am I doing? I'm sorry, that's a bull put again. I meant the bear call. Okay. All right, bear call credit spread. Index is at 39.30. I probably want to sell 39.80, 39.90. Now, I think I'm going to stick with what I said. I'm going to use the 405, 415 to start. Let's see where that gets us. Out of the money calls, we're going to create a bear call credit spread expecting SPX in the next 7-9 days to stay below 4,005. Okay. So we're selling the 4,005, buying the 4,015, keeping the 10-point strike difference. That's a very high return. Now it's only 70 points out of the money. Where's my probability? Probably below 69.1. Yeah, we're going to have to up that. I think it's going to be the 40-20. But in any case, let's just stick with this. 52.7% return as long as SPX stays below 4,005. Again, I'd probably now be going to the 4,020 now that I see the probability. I want to be in that 75 to 80% range. The parity trade. Now, these bid-ask spreads, again, $1.30, not too bad. $26 to $27. $1.30 difference is not too bad. $29.40 to $30.80, we're at $1.40. Midpoint, I believe, getting close to 30, 30.05 or 30.10. Selling to open the 4,005 call is feasible, not out of the realm of possibility. 4,015 call at 26.65, 26.70 buy, not unfeasible. Pretty reasonable pricing there. Okay, so this is not a bad net credit to expect, but again, little risky, only a 69% probability. I want to be up to 82, 83% probability, 85% or higher, if the return still matches what I want. Parity trade. Instead of selling the out of the money 4,005 call, buying the 4,015, we're going to sell an in the money 4,005 put and an in the money 4,015 strike call. So we'll go back into our option chain, go into our puts now instead of the calls correctly, and select our 4,005 and our 4,015. Same strikes that we would have used for the bear call, but wow, that's more along the lines of what you'd expect with an in-the-money call. It's a little bit wider than I'd think. Some of these are close. This one's only $3. That's on the SPX Weekly. And this one's only $3. That's on the SPX Weekly, the one that expires in the evening. These are the Thursday AM or Thursday PM expirations, really Friday morning expiration for the standard index. But there's a 40-point bid-ask spread coming across the exchanges at the end of the day. This is kind of what I wanted to illustrate for Maurice in this one issue. What is the difference between the two other than the actions themselves? Well, the difference that comes into play is that when you go in the money with the debit spread for the same probability, 69%, are we looking at a similar return if we get midpoint? Close. 56.3 versus 52.7. This one actually is a little bit higher. But to me, this is illustrating the idea there's no guarantee really of any kind that I'm going to get this midpoint pricing. This is a 50% bid-ask spread. What do I mean by that? The bid-ask spread is 40 points against a bid of 80. The difference is 50% of the bid price. There's no way I could expect to be guaranteed to get the midpoint price on this. Whereas we saw in the bear call, the out-of-the-money calls, the bid-ask spread was very reasonable. Deep in the money options that give you that 70, 75, 80% probability like to see, even on common stocks, will have a wider bid-ask spread, which means it's more difficult to get the fill price to compare the true parity, where here it looks like the Bear Put Debit would be giving us a better return, and it would if we got the midpoint pricing. So, where I'm going with this, to answer Maurice's question, when would we do it? When we feel the market is bearish, when we see the market sentiment turn. And what is the main difference between a bear call and a bear put debit? Well, if you're comparing same strikes and same expiration, they are parity trades. We have a much better tool that you can use to analyze the parity trades. We'll review that in just a moment. But how are they commonly used? Although we're looking at a bear put debit, this is a common bear call credit spread structure one would use. Out of the money position, double-digit return, think more along the lines of 11, 12, maybe 15% return as a guideline. Return maybe 11 to 15. Hey, there's nothing wrong either with a 7 to 8% return if you're getting a 90% probability, you're consistently getting a 90% success rate and just taking less return consistently week by week by week. That's perfectly fine, don't get me wrong. Just takes longer to maybe achieve your goals. We look for that return with a probability usually of around 80 to 85% or higher. I prefer 85% or higher on stocks. I might prefer about 78% or higher on a broad-based index, SPY, SPX, QQQ, or so forth. The stock can stay the same, move up, or move down, and we're making full profit on the position, which again is only going to be around 11 or 12%. Credit spread use, that's a common approach. You can use it shorter term, 7, 14, 20, 30 days out in time. A more common approach for the debit spread is not necessarily to go for the parity trade deep in the money because of that bid-ask spread issue that I mentioned, even if it does look like it's showing a higher potential return compared to the credit spread. There's no guarantee you're going to get the midpoint price in that case. How many investors like to use the debit spread is to go further out in time. 40 days, 60 days, 50 days out in time or more. Let's see what we've got. First 49 days, that's good. 52, that's great. 70 days to February. Let's go January 30th, not the quarterly, that's the 31st, isn't it? But let's go with January 30th, 52 days out in time. And less strikes now because we're closer to the expiration. And we're right in between. I'm going to straddle it. I'm going to sell in my Bear Put Debit Spread and at or just slightly out of the money 39.30, while at the same time buying a 39.40 that's slightly in the money. I've given myself 52 days on this position, a long time frame. I paid a debit of 410 at midpoint, and here the midpoint's more reasonable. 3 points. It's not as deep in the money, not as wide of a bid-ask spread. That's reasonable for an option priced at 115, 118. And 3 points, $3.40, actually $3.40 on both. My apologies. So getting the midpoint here, I believe, is pretty feasible. But I'm straddling the price. You know, I'm starting off really, really close to the break-even value, right? I'm not too far away from it. My break even, that's at expiration, it was 39.35, and I'm already at 39.34. So we just have a small movement until we start losing money on the position. And our curved red line, which is usually you see something that would go like this, is very smooth because of the delta effect of being right at the money. The goal of this position, this structure that is used by investors, is not the expectation that come February expiration, January 30th, my apologies, expiration, that SPX is going to be trading necessarily below 39.30. The investors are expecting a movement down, and I know it's not that much, it's only 4 or 5 points, to where when the stock reaches here, the max expected profit is 590 off of a 410 debit. This is the advantage of this type of what we call an at the money or out of the money debit spread, because it gives you a 1-to-1 risk reward ratio. You paid 410, you're risking 410 if the stock SPX moves up here and both options expire worthless, assuming you held it all the way to January and made no adjustments, which you wouldn't do. But you have more of a 1-to-1 risk reward ratio in this case, a little bit better than that. But the goal is to close this position if you can liquidate both options and get 50% of the maximum profit. Maybe even 30%, maybe even 40% if it happens in the first 10, 12, or 15 days. We move down here and we can take 30%, 35% off the table of this max expected profit. What would 50% be of 590? Of course, we're talking about $295. but you're making 295 in that case off of a risk still of only 410. That's a really good percentage return when that happens. Okay, so this is an approach far out in time with a debit spread. Why don't investors commonly use this with a bear call credit spread? Why wouldn't I sell the now in the money 39.30 call and buy an out of the money 39.40 put? On SPX, you might get away with that because it's cash settled. You don't have to worry about early assignments, European exercise. But on standard stocks, on the bear call, this would be in the money. So at any given moment, you're risking being assigned on your short call at 39.30 if the stock is within this range. You can't exercise the 39.40 to cover that obligation because this is still OTM in the case of a bear call credit spread. So you're sort of in this risk land where you've got an in-the-money sold call. The bought call that's protecting is out of the money. You're in no man's land between the two, and you can be assigned at any time. That's why the debit spread is used in this one-to-one ratio, straddling the price, and the credit spread never is. It's just too risky for early assignment on a stock, commonly used stock, or anything along those lines. So it's just not regularly used. So again, Maurice, use it when you think the market is bearish. A far out in time debit spread approach is a good idea and has been successful for many, but you're not looking to make the full profit. You're looking to make about 50%. But when you're doing a credit spread, you're going out of the money. But as we showed earlier, if I'm going out of the money with the probability we want for a bear call credit spread, and we use the same strikes, same expiration date for the Parity Bear Put Debit, we're going to see wider bid-ask spread on the in-the-money put options. No guarantee you're going to get filled. I did mention, of course, we'll come back to this, but I did mention an easier tool to use. So let's go to, doesn't matter, bull call debit. We're going to go to the spread chain. Our spread chain just allows you to put in one symbol at a time. So we're going to put in $SPX, and we're going to put in a spread width of 10. Minimum net credit doesn't have to be $1, but it does have to be at least 50 cents. Out of the money range, I'm not going to use a percentage out of the money range, but what I'm going to use is a probability. And of course, a minimum return, we're going to go at least 7%. But my probability range, I want to be above 78%, as I mentioned. Now, you can look at credit spreads side by side, the bull put credit and the bear call. You can look at debit spreads side by side. Put credit and call debit parity, or bearish, bear call credit and bear put debit parity. Let me submit that. Go to here, and let's select our expiration date we want of December 16th. There we go. That's odd. Nothing matches my criteria. Oh, I didn't want 11% out of the money. That's why that rewrote everything for me. I'm sorry, folks. Is it 15? I'm sure. And yeah, nope, 78. Sorry about that. All right, let's get that. There we go. Okay, so here we see the probability 78%, 80%. What's happening? The returns are declining. And this is our bear put debits. And here's our bear call credit. So when we get up into that probability of 83% or so, yeah, still looking at double-digit returns at midpoint prices for the bear call credits, which is good. But you can compare it side by side to the debit spread. Let's restrict this a little bit more. Let's go to that 82 or 83% probability I really want, up to 87 only. We're still looking for a 9% return. Okay, that's a little bit better. So here we see the 40, 70, 40, 80 with an 82.9% probability bear call credit spread. Deep out of the money, 7 days to expiration, 22% return. Debit spread is only 20.5. Okay, so in this case, I would be more tempted to go with the bear call, but sometimes you see differences. Let's look at the 40, 75, 40, 85, 83.8% probability, 19% on the call side, 20.5% on the put side of the in-the-money bear put debit. But again, bid-ask spread 128 to 192 across the exchanges at the close of day. That'll clean up as soon as more open interest and volume clicks in. There we go. And 119.70 to 183.70. So there's no guarantee that we're going to get that midpoint price and get the better 20.5% return on our bear call dollar bid-ask spread, 910 to 1010, 1070 to 1170. Really feasible we could get that midpoint between the two of just 50 cents above or 50 cents below. So this is the tool here, the call credit put debit parity, put credit and call debit parity under the spread chain view that we like to use to quickly evaluate that. Okay, so Maurice, I hope that answers your question about the debit spreads, the bearish credit, bearish debit spreads. What we typically look for in those scenarios, what one might use as a debit spread combination versus a credit spread, looking for the higher probability. SPX is a little bit different naturally because we don't have to worry about early assignment, but that's always a reason why I would never do this structure with a bear call credit spread where I'm straddling the stock price. That's only done with a debit spread on a stock to avoid the early assignment. Carol did ask, will this be archived? Yes, Carol, this recording is archived as always. The full presentation will be available for PowerOptions subscribers at or around 7 o'clock, 7:10 p.m. Eastern. The various segments that we're going to break this up into are probably going to be discussed, split up by me and posted on Saturday, in addition to maybe Paul's discussion from last week. Now, okay, so Fernando's comment to support what I said at one point, he said the in-the-money spreads are dangerous for execution price bid-ask. He means the in-the-money debit spreads. You need a broker that makes a combination like IB, because you're right. You can get stuck with that improper bid-ask spread. And he says the initial probability is strong depending on management techniques. Yeah, 69% probability might be okay if you have strong management as well. Now, Fernando brought this up before. We've discussed this briefly before in a conversation. This is the debit spread that we looked at. Straddling the stock price, we'll call it 39.35, relatively close to it. What are we doing? Selling the 39.30 put, which is slightly out of the money. We need a bigger move to achieve maximum profit. And we're buying the 39.40, again, just about 5 points above, 5 points in the money. Now, if you wanted to put up the margin, Fernando's comments is you can finance the bear put spread by selling more deep out of the money. What does he mean? The debit between these two positions was only 410. So if I wanted to finance this for a credit, though it might be expensive on SPX because we'd have to put up the margin requirement, but again, all I have to do is find a deep out of the money put that's priced at $6, $7, maybe $8. Let's double the debit, Fernando, and go for a net credit of $4. We have to keep the same expiration, naturally, December 16th. Although I suppose you don't, Fernando. You could skew that to a calendar view. But simply what he's talking about is just selling more, deeper out of the money puts to finance the debit spread. And it's something that can be done, but on SPX, again, that's going to require a high margin. That's not quite 80. That's close enough. Okay, so here, I scrolled down so you guys didn't have to see it. The 37.20 put, bid of 550, ask of 630. 80-cent bid-ask spread, 40-cent midpoint, close to $6. We could just use the 37.25 and probably get 620, 630. But let's just take the midpoint here at 590. Oh no, we wanted 8. My apologies, Fernando. You wanted to go for 8, so not quite there. We got to go to that's 80. Yep, there it is. 37.45, 770 bid, 850 ask. We get midpoint. We're going to be around 810, $8. Let's use that to sell. Remember, SPX is at 39.34. We're selling the 37.45, so we're almost 200 points out of the money in this case. We paid a debit of 410 initially for that debit spread we were looking at, our 39.30, 39.40. We're going to go deeper out of the money here and sell this additional put for 810. So now we get a credit of 400. But the margin requirement based on being cash secured for selling the 37.45 put is extreme. And we end up essentially with just looking at a position that's sort of a naked put trade, meaning that there's loss if we start to drop below 37.34. What is that? Well, this essentially becomes a naked put position at 37.45. We take a credit of 4. So, break even, including the profit from, or the loss on the debit spread there that we'd be looking at. The stock was down this far. Right. Okay. Yes. I'm sorry. Including the gain. My apologies on the debit spread, but if the stock was down that far, that gives us this break even here of 37.34, 10 points down. And so we see something here. Now, a break even is still very far away. Profit zone is between, a good profit zone here is between 37.45, that strike price, all the way up. It's still technically a bearish position with no risk to the upside and needing a 200-point drop essentially to hit to break even. But it's trade-off, isn't it? Comes with a much higher monetary requirement in this case, because you have to cover the obligation of this put being naked, because this put is covered by the long put. You don't have anything covering this put in this case. Someone comments, could you do double bear put debits? Yeah, you could do ladder debit spreads, but it's not something we do. Instead of considering a ladder debit spread, what I would consider, John, is just simply selling twice as many of the initial spread I liked that matched my criteria, rather than trying to do a laddered spread with further out of the money bear put debit or bull put credit and so on and so forth, and complicating the position and having 4, 6, 8, 10 working legs on the same strategy. That's not what I prefer to do. Just to keep it more simple in my mind, just do one spread, but if I really have the strong sentiment, I'll just increase the contract size, increase the debit in this case, as opposed to trying to ladder down and add another debit spread further out of the money or a bull put credit spread to help try to pay for that position. Why try to confuse it by having 6 to 8 legs where one's bullish, one's bearish, and one's maybe a delta neutral? You've got to manage all 3 of those separately as SPX moves up and down. Keep it more simple based on your direction rather than try to overcomplicate it, thinking you're making a good hedge, but now you're making more work for yourself, having to watch, track, and adjust 3 positions with 3 different sentiments on the same security. That's always the way that I felt personally. And of course, yeah, I did use the shorter term one here for that example. I meant to emphasize that because I could get the credit using shorter term and continue to sell against this almost like a working security. Instead of selling calls against owning SPY, I'm selling near-term puts deep out of the money to pay for the debit of a bearish debit spread. And again, that does add confusion because I'm in a bearish debit spread, but I've sold a neutral to bullish strategy against it shorter term. If there's a sudden drop or unexpected move, I've got to manage this very quickly before it exceeds the 10-point buyback cost or the 10-point strike difference that I'm going to get in profit on the initial spread as it starts to move down. Remember, I'm not even targeting that full 10-point spread or the full 10 points back from the bear put debit. I'm targeting half of this, which is 295. If SPX drops 1 or 2% on Monday and then another 1.5% on Tuesday, the buyback cost of that 7-day out option we sold for $8 might be $17 or $18. That's going to exceed the profit I might be seeing here of 295, well beyond, and have a strong loss on the position.